All right, wonderful. All right, good evening, everyone. Thank you for joining us tonight. My name is Siobhan Shugman. I am the business librarian at Greenwich Library, and I'm very pleased to introduce Kristen Jacks. Kristen Jacks is a financial educator, author, and the founder of Money in Your Twenties. Kristen worked for Kiplinger's Personal Finance Magazine and Mutual Funds Magazine before becoming a writer and speaker. Her most recent book on investing is a lively and jargon-free resource for young adults or anyone new to investing. Kristen is a graduate of Duke University. It's all yours,
Great.
Kristen.
Thank you so much. Can you hear me clearly?
Yes.
Oh, perfect. Okay, great. Thank you. And thank you to Greenwich Library. You guys host so many terrific, informative talks and webinars and things. It's really impressive. Thank you. And welcome everybody to the investing discussion group. Believe it or not, this is our 4th season of running the investing discussion group. And we meet online once a month. And the format is meant to be interactive. So if you have a question, you can unmute and ask it. You could put a question in the chat. So, I sometimes I go into lecture mode. I might not see it, but usually Siobhan catches it for me. But we definitely invite questions, and we like things to be interactive. And every now and then, we have so many smart people in Greenwich. I'll get somebody who really understands some area of finance deeply, and they'll have a lot of great stuff to contribute. So that's really fun. So welcome. This season, we're looking at a variety of different topics, just kind of based on what's been popular, what people have enjoyed, like psychology of investing is always popular, tax efficiency, like tonight is popular, anything about bonds. We're also going to be looking at alternative investments. Those are becoming, or at least the trend is that there's going to be this democratization of alternative investing. So you could actually get into private equity, even if you're not really, really rich. Certain investments are kind of coming for what they call the mass affluent. So we're going to do a segment on that. So all sorts of really great things when we meet once a month. And then for anything that you've missed, all of these sessions live on the YouTube channel for Greenwich Library. So if you've never kind of looked for somebody's channel, you go to YouTube and then you can put Greenwich Library in the search bar. And then you'll see this kind of green and white logo where it's the open book with the tree inside. And when you click on that, you actually go to the Greenwich Library channel. I think it's kind of an odd concept, but it's sort of this subset on YouTube where what's going on at the library is like saved for you, or what has gone on. And all of these videos live there. So if you miss the one on asset allocation, or the one on bonds are a lot more complicated than you think, they're not always safe, you can find all of that there. And then tonight we're doing tax efficient investing. And then planning ahead, we're going to, in November, do psychology and investing, which is usually really popular. And then in December, we're going to do the alternative investment. So that's what I was talking about, where private equity and secondaries and big real estate syndications and all these things are actually much more accessible than they used to be. And also there are really clever ways to access them in a retirement account, and that's something that people don't necessarily know about. I'm going to briefly mention that tonight, how you can do that through your IRA, but we'll go into really in depth in December. Okay, but a quick disclaimer, because we're talking about sophisticated financial topics. This webinar is for educational purposes only. It is not intended to provide investment advice. None of the investments or investing strategies mentioned in this discussion group are specifically recommended or discouraged. Before making financial decisions, you are urged to consult a wide range of professionals, tax expert, lawyer, financial advisor, who are aware of your unique needs and situation. Okay, so in my first book, this was the opening line. Of all the misconceptions about money, the most unhelpful is the idea that handling money is common sense. And if you're new to taxes, maybe you don't know this yet, but I would say that the tax code is so frustrating. I mean, it has a shred of common sense in once you kind of become familiar with kind of how the tax code is nudging you towards certain behaviors and discouraging you from other behaviors, you can see that the common sense thread is kind of incentives of like how the government would like you to manage your finances. But very often the rules, you would just never guess them on your own. So any kind of tax advice really has to be like, you just have to have some sense like you don't know what you don't know. You couldn't possibly guess. And it's really smart that you're doing things like this and, listening to these webinars or listening to podcasts or reading, the Wall Street Journal or whatever you do, because more knowledge is really going to help you and you wouldn't guess it on your own. I personally am very, very fond of podcasts. I have a dog that I overwalk. This is the luckiest dog in America. And the best thing for me for learning is to be able to listen while I'm walking my dog. And there are so many great podcasts about financial topics, and very often they'll cover taxes. And what I've discovered is that if I ran my own podcast, I might call it like Smart Clueless, because there are so many situations in life where you take really smart people who worked hard in school and got an education, and then there are vast areas of their life where they're just completely clueless, whether it's like, how to manage like life insurance or how to manage health insurance or how to, do any kind of DIY project at home. Like they didn't even, these kids that grew up in New York City who have lived in apartments and then come out to the suburbs and they have no idea what an HVAC system is and all this stuff. So there's sort of this whole like smart clueless thing going on, and that's definitely applied to taxes. So when I listen to these podcasts and I have really smart people weigh in and they tell jokes about themselves, they're like, "Oh yeah, when I first got my very first W-2 in the mail, I didn't know what it was and I just threw it out." Right? And you could see that happening. You could see someone going, especially if their parents didn't talk about money, you could see them going all through college and the first year of their job, and then they get that W-2 in the mail and they have no idea what it is and they think it's junk mail and they throw it out. So that was a producer at Planet Money that did that. And then another lady who actually runs a podcast all about finance, she was talking about before she did the podcast, she thought she had been really smart and clever. She was, young and thought she was really on top of her finances. So she wanted her tax refund. So the minute she could, she did her taxes and submitted them so that she'd get her refund. And she was telling her dad that she was really proud of herself for doing this. And he said, "Oh, that's so odd that you could do that already because you haven't gotten your 1099s yet." And she was like, "What are you talking about?" And he's like, "Your 1099s for your investments, right? So that like the interest income you got or the dividend income you got." And she goes, "I get taxed on that? I get taxed on my investments?" And he's like, "Yeah, of course you do. It's like it's income to you." So she actually had to do her taxes all over again and submit an amended return. So even knowing you have to pay taxes on investments that are not inside sheltered, tax sheltered accounts, like that's not obvious to a lot of people who thought they were ahead of the game. So one thing I'd like to do, if you're smart enough to be here and you're interested enough to be here, just kind of deputize yourself and just be one of those people, whether it's your niece or nephew or younger brother or sister or neighbor or best friend or whatever, that like you can just kind of be someone who's available to them to at least help them like have a clue that they don't know what they don't know and to just maybe be on top of it. Any young person is in the weeds when it comes to these sorts of things. Okay, but so how are we going to organize this? Because obviously, like the tax code is like a million words long, and we could spend hours on. I could spend hours just on like if you run a small business, how should you organize your taxes? So let's drill down to what would be like the top line, most important things to get out of the way in 50 minutes. So we're going to just briefly talk about the familiar tax shelters, because if we're talking about tax efficiency, then, it's really efficient to just not have to pay the tax and to have your money, growing tax-free, have your investments growing tax-free inside a tax shelter. And maybe you think you know about all the tax shelters, but we're going to get a little bit beyond the basics because there are tax shelters that are available to you that you might not know about that could be fascinating. And that's the most tax efficient thing you can do is just not have to pay your taxes. But what happens, when you can't or don't shelter your money so that you do have to pay tax on realized gains? So what happens then? So we're going to talk about that because, for spoiler alert, this is the whole, there are capital gains tax rates and there are ordinary income tax rates. And a lot of you are pretty savvy. You probably already know that. But we're going to drill down to like, some investments, they're already hitting your ordinary income tax rates no matter what. Others, you could avoid having it hit your ordinary income and have capital gains rates that are typically more favorable. But that's a timing issue, among other things. So we're going to talk about that. But then we're also going to talk about this assumption that all these financial advisors are making that you always want to get the capital gains rate because it's always more favorable and it's this big deal. And I'm not sure people have really paid attention to how the current ordinary income tax brackets are doing and how large the standard deduction has become. So it's not a foregone conclusion that you're always better off, or it's a dramatic difference, right, with capital gains tax rates. So, you have the two tax rates, you have ordinary income, which is the way you're taxed on like, your salary and stuff. And then you have capital gains rates that are typically more favorable for people who are higher earners, no question, right? It's much better to pay 15% than to pay 35%. Like that's no question. But I really want to make sure you're not just getting this advice from other people and you don't really understand the numbers yourself. So, and especially like for younger people just starting out, it's really not that much of a panic if you have ordinary income rates versus capital gains rates. So we're going to get into that. Then we have to talk about the amazing Roth, right? I mean, the fact that there is a vehicle that allows you to let your money grow tax-free and then like take your money out tax-free, like no tax ever. The tax was the money, like you put after tax dollars in. So like this is money where you paid your taxes, then you were allowed to do all sorts of magical things with it with your investing. And no matter what your investments achieved, you never get taxed. So that is amazing, right? And a lot of people think, well, yeah, it might be amazing, but I can't do the Roth because my income is too high. So for reasons I don't really understand, it's like, yeah, that's the rule, but you can do a Roth conversion anytime you want. Like that is so strange to me. Like, no, you can't put any money into a Roth because your income's too high, but oh, anytime you want to just take an IRA you already have and turn it into a Roth, you can do that whenever you want. How does that make sense? I don't know. But hopefully, people need to know that because if you have a lot of years of letting those monies sit inside a Roth and grow and grow and grow, and then you can take them out tax-free, like that's really exciting. And also, there are just so many situations where you would like to be able to access money that is tax-free. So hopefully that'll make sense when we get there because, stuff that's sitting in other retirement accounts, like you haven't paid tax on that money yet. So when you take it out, you will have to pay tax and nobody knows what the tax rates will be then. And, you might have accumulated a lot of money and you might also have some income you weren't expecting. So having a Roth is a great way to just be able to manage tax consequences. And anybody can have a Roth, even if their income is too high. Then, of course, we'll briefly talk about tax loss harvesting, because if you've been lucky enough to have all these gains, but you don't want to pay the tax, you can do some intelligent things to try to get that tax bill lowered. And we will definitely, do question and answer. Okay. All right, so the familiar favorites, right? It's like, my superhero, whoever invented the 401k. I actually used to know his name. I was that geeky. But it's named after the tax code, right? And so 401ks, IRAs, meaning individual retirement accounts. Like these are the basics, right? These are the things that we usually think of. If you're saving for college, you think of the 529 account, right? So it's good to just kind of know these basics and know how they operate, right? So like a 529 account, yes, your money is growing tax-free and you don't pay any tax when you take it out as long as you are following certain rules about using that money for higher education, right? Certain rules being like you can't, like if your kid signs up for a sorority or fraternity, that doesn't count. Like you can't do that. It's not anything related to college, it's not anything related to education, but if you're paying tuition, if you're paying books and things like that. So those are like the traditional ones. And a lot of people are pretty familiar, if you're at your work and work offers a 401k, or if you're a teacher or a state employee, like they're named different things like the uh, 403B or the 457, right? But they're all, the idea is you can take part of your salary and you can, push it off into this retirement account. And then it doesn't land on this year's taxes as income, right? So you're effectively lowering your income for this tax, the tax year that you put money into a retirement account. And so that's good news because you're taxed, your whatever your marginal tax rate is, you're lowering that burden. And then you're allowing money to grow tax-free. You're not allowed to take that money out and then not pay taxes on it though. So like this is the difference between like the familiar and the traditional ones, the less familiar, the Roth, where in the Roth, when you go to take the money out, it's tax-free, no matter how it has appreciated with however you invested it, it's tax-free. But the more familiar ones, the 401ks, the IRAs, right? Those are your taking money off the top of all the money you've earned, putting it into sort of like this invisibility cloak. So like the government's not looking at it that year. So you're not paying tax on it that year. It grows tax-free, but then you're going to pay tax when you take it out. Now, again, saving for college, the 529, a little bit different. It's not, you're not having those monies disappear. You're paying your federal tax in that tax year. However, depending on where you live, you could get a discount on your state taxes. So this is where, the tax laws become a little bit complicated. It's like the 529, no, that's not a tax deduction for me this year, but it could be for my state, depending on, do I actually it doesn't matter if you use a 529 that plan that is you could use it out of your state and still take the state deduction, but it's just it's just a little bit confusing to people that it's like, oh, this is what I'm using for to reduce my state tax but not my federal tax. Okay, so beyond the familiar favorites though, if we're really going to get into tax efficient investing, I think it's super, super important to understand that there's something called the self-directed IRA. So as you've grown your tax retirement accounts, say you've, had several jobs and you've had 401ks at different places and you didn't keep your money, where the 401k was, you rolled it over maybe into the current work 401k, or maybe you rolled it into an IRA. You have this money that's accumulated, and very often you've probably rolled some of it into your own IRA, right? So it's no longer connected to any of your employers. Well, it's still at a brokerage, like a custodian, that is offering you the typical menu. You can buy individual stocks, you could buy individual bonds, you could buy mutual funds, you could buy ETFs, right? So that's very typical. That's what you have access to in an individual retirement account. But a lot of people want to be in real estate, for example. Like they'd love to own a rental property. They'd love to be, investing in a rental property that's throwing off income, right? But they don't want to pay tax on that. But they kind of don't know how to do this otherwise, right? Or, maybe you really would like to invest in gold, or maybe you really would like to invest in cryptocurrency and not have any tax consequence. So self-directed IRAs are, you basically take your IRA and you switch it to a different custodian. So it's a special custodian, and there are many of these special custodians that will take your IRA, and instead of saying, well, here's the typical menu of stocks, bonds, mutual funds, they will let you invest in alternative assets that are pretty fancy, right? I mean, you could invest, if you wanted to, you could invest in oil and gas. If you wanted to, you could invest in livestock. I mean, if you find out about these investments, I mean, people will reveal to you a whole different landscape of investing that can be very, very lucrative. And it's all perfectly legal. Once you get into real estate, you have to be really careful that you're not, for example, you have to follow certain rules. Like say, you'd love to flip a house, right? There are a lot of rules. Like if you're going to become like a continual house flipper, you cannot do that. Right? Maybe you'll get away with one, but if you're going to have like this continuous business of flipping houses, the government is onto you and they're like, you're basically running like, a house flipping business through your IRA, and we're going to penalize you for that. But you could hire someone else to do that on a serial basis for you. And then you just structure it that all you're ever doing is lending that person money through your IRA, and then you could actually do it. So it's really just fascinating. It's fascinating to know that you can go well beyond typical investments and still have everything tax sheltered and be supremely tax efficient while you're letting your money grow. Okay, and I just included this so you understand, like when you hear about this trend that's coming of like the mass affluent having access to alternative investments. And by the way, I'm guessing that a lot of them are using self-directed IRAs to, access these alternative investments or pay for these, or to that's where they're keeping their alternative investments. So that's where they're keeping their private equity or private credit or private real estate, all this stuff. They're keeping it tax sheltered. They're keeping it in a tax sheltered account that's probably a self-directed IRA. So, but much more on this when we do the alternatives in December. Okay, and then something that is recently on my radar that I find fascinating, that I'm calling kind of the stealth tax shelter because of new tax laws. I mean, the qualified small business stock, like how the latest tax legislation is dealing with people who have the guts to invest in things that are highly risky, the startup world. The people who have the guts to do that are getting rewarded, no kidding, with no tax, even if their gain is up to $10 million. So I've become fascinated with this. I mean, this is definitely for a much more mature audience in the sense that, well, first of all, you have to be an accredited investor. So you have to have at least $1 million in assets, which actually outside of your home, which is actually not that hard to do once you're like in your late 50s, early 60s, and you've just been contributing to, a retirement fund. But you have to be an accredited investor. But it's amazing now, the idea that if you get into that startup world and and you understand the rules and you get in on the ground floor of a startup, if that startup does well and say, you get 5 times your investment back, 10 times your investment back, you don't pay any tax at all, no matter what. I'm not kidding. You can actually listen to this podcast that I have on this slide. So there's a podcast, the actual show is called Tax Smarts Unlocked. And the particular episode is this episode that was August, I think it's hard for me to see on the slide, but I think it was August 18th. But it's talking all about this new tax law and the qualified small business stock and how if you get in on the ground floor, because you have to have the original issue of shares, right? And this has nothing to do with loaning a small business money. You have to be getting an equity position in the small business, and it has to be original, right? It can't be somebody bought into a small business and then sold you their shares. It has to be original. But if that small business takes up, that startup takes off, you could honestly have no tax on an enormous gain. So don't take my word for it. You can listen to this podcast, but there are so many things going on out there where you can be investing and setting yourself up for no tax, right? So you have tax shelters, you have this, I kind of call it a stealth tax shelter. There are just so many really, really interesting things going on. Okay, but so what happens when you can't or don't, shelter your money, right? You just have a regular brokerage account, you just have regular savings. What is going to happen in a particular tax year when you have dividend income or interest income, or you have a stock that's gone up and you've decided to sell it, right? Like what's going to happen? All right, well, it's it's complicated. It takes some getting used to. Once you've done it for like you've been, 3 or 4 tax returns in, you kind of get the handle of it. But there are a lot of moving parts, right? So the very first thing to think about is just timing. So we're going to talk about timing, and why does time matter? Then there are different rules for different things, right? So some bonds are taxed, like a muni bond, you don't have to pay federal tax. Other bonds, you don't have to pay state or local tax. Um, it, it's really interesting. So let's jump into the very first thing that like is the most basic thing to understand is this obsession with how long you've owned your asset, right? Whatever that asset is, right? Stocks, bonds, real estate. Real estate, especially if it's your home, there are a lot of things to attach to what the capital gain might be. Um, so it, but let's just start with, any asset, if you own it for a year or less, a year or less. A lot of people, tax experts, just to as a kind of a shorthand, will be like less than a year, more than a year, less than a year, more than a year. That's the distinction. It's close enough. I mean, but really, to be totally careful and precise, it's owning something a year or less means that's a short-term gain. And because it's considered a short-term gain, it will hit your ordinary income rates. Owning something more than a year, just one day more than 1 year or more, that's a long-term capital gain. And that triggers the capital gains tax rates, which people get very excited about. They, as a broad statement, they say, oh, they're so much more favorable than ordinary income rates. So we're going to make sure that you understand that. Like, that's a broad statement. Is it always true? Is it always dramatically true? No. So you just have to understand what we're talking about here. But the very first thing, like the tax consequences of investing, how long did you own the asset before you sold it? And here we're talking about a gain, right? Because you're not going to get like a tax consequence when there's a loss, although you'll use the loss to offset other gains, which is the tax loss harvesting that we're going to talk about later. But very important, when you own an asset, own it for a year or more if you want the capital gains rates. If you don't care, you can own it for a year or less. That's short-term capital gain versus long-term capital gain. It's a little bit confusing because they'll say it's a short-term capital gain. They'll still talk about capital gain, but then you can't use the capital gains rates. So it's not that there hasn't been a capital gain. It's how long did you own the asset? Okay, so that's the number one distinction, and we're going to get down to the tax consequences, the actual tax rates. But then let's talk about some of these assets, right? So you have bonds, you have stocks, you have stocks that pay dividends and stocks that don't pay dividends. Now, if you own a stock and it appreciates and you decide to sell it and you've owned it for more than a year, yes, more than a year, then you get the capital gains tax rates that everyone is going to say are like far more favorable than ordinary income rates. We're going to get into that. It's definitely true if you have a high income. However, if you own a stock and the stock is paying dividends, this is where it gets really confusing, because I will tell you, you just get a brokerage statement and it says this amount, in this box here, you had qualified dividends, this amount. In this box here, you had ordinary dividends, this amount. And most people do not understand how you ended up in one box or the other, right? Because you really want your dividends hitting, you don't really want your dividends hitting your ordinary income rates typically, but sometimes they do. And when I read the actual publication from the IRS that says, like, how does that happen? It doesn't really match up with, there's one instance that we know why it happens. And that's because you didn't own the stock that issued the dividend. You didn't own it long enough, right? This is going to be really confusing, but this is straight from the IRS. You bought 5,000 shares of XYZ Corporation common stock on July 8th. It paid a cash dividend. The ex-dividend date was July 16th. So your Form 1099 div from XYZ Corp shows $500 in box 1A, ordinary dividends, and in box 1B, qualified dividends. However, you sold the 5,000 shares on August 11th. You held your shares for only 34 days of the 121-day period that you were supposed to hold them, right? So you don't get to treat these as qualified dividends. All right. This is confusing, but basically, you're supposed to own your dividend paying stocks for a nice long stretch of time. I mean, they're saying, like, it's not just 121 days, it's specifically 121 days hovering around the ex-dividend date. But I mean, the spirit of it is you're not supposed to be trading in and out of dividend stocks. If you're doing that, you're very often disqualifying your gain, your dividends. Instead of being qualified, they become ordinary, and then they hit your ordinary income. But I find this really confusing because it doesn't always add up. I mean, I just so you know, like, I think you should just be highly suspicious and be, if you do not want to add to your ordinary income, just be very careful with dividends and make sure you understand if they're going to be qualified or not, if they're going to be hit capital gains rates or not. Because this is the one thing I find is that people are still running afoul of it, getting confused. Financial people on, who write articles for the Wall Street Journal and things like that, for Forbes, whatever, they can't fully explain what's going on. So maybe this is only for your tax expert to help you with. Okay, so yeah, nobody understands qualified versus ordinary dividends, or like how they're ending up one or the other. Okay, so interest on bonds, or just bonds in general. There are so many flavors of bonds, and there are so many potential benefits depending on the bond. And I'm not going to get into all of them, but this is definitely, like, once you realize, like, what you want to do with your money that's outside of a tax sheltered account, and whether or not you only want capital gains, or you can handle having ordinary gains because you're not in a very high tax bracket, then you're going to want to know all of these things. And, sometimes there's no federal tax. Sometimes there's no state and local tax. Sometimes you have a lot of interest that's accumulated. But this blows my mind. There are certain bonds issued by the government, like I bonds, where as long as your income is low enough and you can spend the interest on qualified education expenses, then you pay no tax whatever. So this is what makes the whole investing field confusing, because there's sort of like a perfect investment for every family. It just depends on what they're trying to do. It depends on their tax bracket. It depends on their location, right? So again, like, if you're going to be able to not have to pay state tax, but you live in Texas where there's no state tax anyway, it's like, that's not appealing to you. So this is where tax efficient investing really becomes a puzzle, and it's very personal to you. right? So, you're not going to go out of your way to own bonds where you don't have to pay state and local taxes if you live in a place that doesn't have state and local taxes. So this is why you want to understand kind of like every flavor of every investment and what it's doing for you. And it's also why you want to assume that you don't know, because people invest in gold. I mean, gold has gone through the roof recently, and I promise you they don't understand the tax consequences. For reasons that I don't really understand, gold is taxed differently than other investments. So you're going to get hit with a 28% tax on gold that, if you had known that ahead of time, you probably wouldn't have selected that investment. So, yeah, it's, I can't teach it all in one night. All I can say is, you're going to get to know like who you are, if you want to avoid ordinary income, if you're okay with ordinary income, if you have high state taxes, if you have low state taxes. It's very, very personal. If you have educational expenses coming up, if you don't have educational expenses coming up, these are all the things that you need to consider when you're trying to pick those perfect investments and be as tax efficient as possible. Okay, so let's really understand the difference between capital gains rates and ordinary income, okay? Because you will hear over and over again that, of course, you want to capture those capital gains rates because they are so, so, so favorable. And ordinary income rates are so, so, so bad. Okay, we got to test this theory, because if you've been paying attention, so I say like most tax advice assumes your ordinary income places you in the 22% bracket or higher, right? Well, let's hold on a second. So the standard deduction in recent years has gotten pretty high, right? So this is for 2025, and it even got higher with the one big beautiful bill. If you're single, your standard deduction is 15,750, right? If you're married, your standard deduction is 31,500. If you're a senior, I don't even have that on here, but it's even higher than that. Like you get even more of a standard deduction if you're over 65. Well, that's pretty nice. Then if you look at the actual brackets, so these are the brackets after you've taken your standard deduction. And I know this is a mess. I know people hate all the numbers, but let's just take a peek, right? So there's the 10% bracket and the 12% bracket. And if you're in that 12% bracket, right, the tippy top of that 12% bracket, and you're single, you're looking at that 48,475, right? And you're adding to it the standard deduction. You're adding the 15,750, right? So now you're at like $64,000 basically of income, where if you had a typical like short-term gain on an investment, you're only paying 12% on it. Okay. Well, that's actually pretty good. And it's shocking that it's better than the capital gains rate. And I bet you don't believe me, but I'm going to show you. So let's look. So here's the capital gains rate for single, 15%. Well, I mean, zero, right? So if you're at 64,000, then you're hitting the 15% capital gain, but you'd only be 12% with your ordinary income. I know there's a lot of numbers and it's very confusing, but it's not like an across the board, like it's always so, so much better, right? And if you're married and you've got, you're still staying in that 12% bracket, you have a standard deduction of 31,500, even higher if you're a senior and you're married. So you're taking the 31,500 and you're adding it to the 96,950, right? So you've got you're in the 120,000 high, whatever that is. You're still in the 12% for your gains. So it's not like this catastrophic thing always to have income, to have your investments hit your ordinary income rates. And then even if you are in the 22% bracket, right? Okay, well, that's not, it's not great if it's hitting your ordinary income. But like you can go really far with that. If you take those rates, you're single $103,000, then you're adding your 15,750, right? You're going pretty far hanging out in the 22% bracket. If you're married, the 206,000 plus the, 30 plus thousand, like you're doing pretty well keeping within the 22% bracket. And if you got the capital gains rates, you get 15%. Okay, so 15%, 22%. Obviously, it's better to pay 15%. It's worse to pay 22%, but it's not awful, right? It's not terrible. So hopefully this makes sense to you. Hopefully like this is how this works. Like these are these different ordinary income tax rates. And these are truly the capital gains tax rates. And this is, not hard to find. Just go on the internet and just Google like 2025 capital gains tax rates, 2025 federal income tax rates. You'll have access to all of these horrible numbers. So, but when does everything get alarming? Okay. Well, here's how I like to think of it. I have this friend who's got super, super, super white skin and red hair. And if she goes near a light bulb, she starts to freckle, right? And then I have this other friend who could be in the sun all day, with like no SPF. And she just tans beautifully. She never burns, whatever. So this is the way I'd like you to think of people who have to really worry about anything getting added to their income, right? They're already in a high tax bracket. So that's the redhead, right? She's going to get burned. If she has any additional income added to her already high income, she is getting burned. Well, why? Okay, well, let's just say that you know, she's married and she has a really high income and her husband has a really high income. And because of that, their marginal tax rate is 35%, right? Well, that 35% is much worse. Paying 35% is much worse than paying 15%, right? So clearly, like if she and her husband could get away with only paying 15% on their gains, that would be much better than having to pay 35%, right? So who are these people who really have to worry about, uh-oh, I triggered a short-term capital gain. Now it's going to hit my ordinary income. Like, who are these people? These are the people who make 32%, 35%, 37%. Not that they make it, they land in those brackets, all right? So that's the way I'd like you to think about it. Think about it, it's like these are the people who get burned, right? They cannot be near those, they cannot have any ordinary income rates. But meanwhile, my other friend, who's just, perfectly happy teaching yoga and, having a relatively low income, and she doesn't live anywhere near here. She lives in Wallingford, Connecticut. That's an adorable town that has the Choate campus in it. And, she just doesn't really worry that much about money because her rent is only $1,000 a month and she's perfectly happy. She doesn't need a high income. So she doesn't have to worry that much about whether or not like her investment is triggering ordinary income rates or she's getting capital gains rates because she's just in that 12% bracket and it's just not that big a deal. Or even someone honestly who's in the 22% bracket, it's not this dramatic deal to pay 22% instead of 15%. So all of this tax efficiency, the people who get really hyper about it are the ones who, when you look at that 15% bracket, and you realize that they could have like up to $650 of income where from investments where they're only going to have to pay 15%. And the absolute worst case scenario is 20%. And it doesn't even matter what it's like, it doesn't matter if made $2 million, you're going to pay 20%, right? So so it really only matters for the people who are in the 32, 35, 37 percent bracket, they have to be obsessive about this. Okay. They are like that friend of mine who's going to burn in the sun if she doesn't take serious precautions. Hopefully this makes sense. Okay. I should pause. If there are any questions, go ahead and put them in the chat. Let me see. I don't know that we have anything in the chat. It looks like not right now. Hopefully this is making sense. Now we're going to move on to the amazing Roth, right? Because talk about tax efficiency. I don't know why it says the yield curve there. Just ignore that. But I love this. I'm going to get a dog and name him Roth. I think that is hilarious. So that was Chris Hogan. Chris Hogan has written a bunch of books, and he used to work with Dave Ramsey, and he's like a commentator and, financial guru, and he's just very funny. But why are people like so obsessed with the Roth? Well, there are a bunch of reasons, I mean, it's not so amazing. It's like you're putting in after-tax dollars, right? So it's like, that's not so fun to have to do. But the idea that you can put money away and then no matter what happens to it, if you're brilliant with your investing, if the money grows, when you go to take it out, you don't pay any tax. That is pretty fascinating, right? That's pretty exciting. But it's also become really an interesting thing when people start being concerned about, like, say they've accumulated a lot of money in their IRAs and they're nearing retirement, but they're thinking like many steps ahead to a time when they're going to have to take RMDs, so required minimum distributions from these IRAs. And that's far off in the future, but a lot of people say that our tax rates are so favorable, and historically our current tax rates, even though they look very painful to some people, like 35% looks very painful, 37% looks very painful, our tax rates are better than in the past, like much better. But our debt is out of control. So a lot of people assume that taxes will have to be worse in the future. So there are people who are thinking, wow, when it comes time for me to take my required minimum distributions from my IRA, those dollars, these tax brackets might be much worse, right? So that's one school of thought. Like, how am I going to, like, I might just get killed on taxes. So there are people who plan far ahead to do a Roth conversion. Now, what's really interesting is that, like, you cannot contribute. People who earn too high an income cannot contribute to a Roth. And even if they could, the limits are kind of small. But at any time, anyone can do a Roth conversion. This kind of blows my mind. Well, obviously, you're not going to do a Roth conversion if you're in a very high tax bracket right now, right? You're just not going to do that. Because what a Roth conversion is you're basically saying, I'm going to take money out of an IRA and I'm going to pay the tax on it right now. And my tax is going to be at my ordinary income rates. Hold on, I do see a question in the chat. Let me just take this one. Is there an age limit for opening a Roth? That's really interesting. So I have listened probably to 15 or 20 podcasts about Roth conversions. And what they always talk about is they're talking about this window where you've retired, or you can retire, or whatever. Maybe you can even take a sabbatical because you're trying to get that one tax year where you don't have your salary and you don't have your pension. You're trying to get that one tax year where your income is the lowest, but you have all this money accumulated in an IRA. And they're usually talking about how that's probably age 62, 63, kind of like your perfect Roth conversion years. So no one has ever mentioned an age limit. But, knowing the IRS, there probably is some funky rule out there. I don't know. But definitely while you're in your 60s, and up to your 60s, I mean, all these podcasts that I've listened to, they've never mentioned it. But it's, good thing to check. I actually keep a list of these. So maybe I will, at the beginning of the next webinar, I can answer that question. So I'll ask, but I haven't heard it ever mentioned. Okay, well, I think there was one other question. Was there another question? No, I guess not. Okay. All right, so stay with me here. We're talking about this Roth conversion. So what a lot of people are encouraged to do is, they're older, they've accumulated a lot of money in IRAs. They just know in their retirement that they're going to want the option to tap into money where they're sort of controlling the tax rate, right? And they're minimizing the possible burden. So you can imagine a scenario where someone's retiring, say they're 62, like say they had a really high income, all the way up, late 50s, early 60s, and then all of a sudden they're going to have this like unbelievable low salary, low income tax year because they just retired. And that's the perfect time to do a Roth conversion where you take dollars out of your IRA and you put them into a Roth. And so just to make like the numbers simple, let's say you take $100,000 and you do that. And in that particular tax year, you're only in the 12% bracket. You used to be in the 35% bracket because you had a big job, but now you've retired. So now you're making sure that that 100,000 is only hitting that 12% bracket. So you have to pay the $12,000. And actually you have to have the cash to pay the $12,000, not from that $100,000. And there are lots of rules like this. So if you ever want to attempt a Roth conversion, you would just make sure you know all of these rules. But you have to have that ability to pay that tax. You have to have 12,000 cash somewhere else to pay the tax on the 100,000 that you've converted. But now, as things happen, like say a pension's going to kick in, or you're going to want to start taking money out of your IRA and you're going to bump yourself up into a different bracket, hopefully you can see how what the whole point of a Roth conversion is that you figure out a way in a few tax years where you can hang out at like maybe the 12% bracket or maybe even the 22% bracket, where you're only going to pay that amount on what you take out of your IRA and you put it away in a Roth. And then later on, if the tax rates go up, you're fine because you have some money to access that's in a Roth. Or later on, if for a variety of reasons you have income from other sources and you're pulling money out of your IRA and it has to go into your normal tax rates and you're putting yourself into a higher tax bracket, you always have Roth money where when you access it, you haven't triggered anything else, right? You're not adding to your income. So Roth conversions are hugely popular. They're not to be confused with backdoor Roth, mega backdoor Roth. When you start hearing that stuff, that is different, very complicated, and often, sort of unique to say like a bunch of doctors in a practice. They know how they want to manage their practice and their retirement rules to be able to do a mega backdoor Roth. Like that's not the same. So I'm just talking about Roth conversions here. So the backdoor, the mega backdoor, that's different, and ignore it for now because it's complicated and it probably doesn't apply to you. But everybody should be excited about the Roth. It's such an amazing opportunity to have money growing. And then when you go to access it, it will be tax-free. All right, let's see. Oh, I do want to say, by the way, that the whole Roth IRA, Roth conversion things, like this was all this kind of fascinating puzzle that we already covered in one of our episodes that lives on the YouTube channel. It was based on, it was like, can your tax, I think it was called like, can you really pay zero tax in retirement or something like that? And it was based on The Power of Zero by David McKnight. And it was really interesting. It's like, if you're going to have to pay, if you're going to get Social Security benefits, this is exactly how using your Roth money, using money that you borrow from your life insurance, and how the Social Security tax rules work. how you could actually have, not forever, but like you could maybe pull off a year or two of having zero taxes. And so that was really cool. And that was a really popular video that we did. I think it was 2 years ago now, but definitely worth a look, or just read The Power of Zero. And I'm sure the library has a copy. Okay, tax loss harvesting. Okay, we have to cover this just briefly because obviously, if you have investment gains and you're poised to pay taxes on them, one option is always to look at everything you own tax-wise. And if there's something like, a stock you own or a mutual fund or something, and maybe you just don't love it anymore. It's not just that it's down, right? It's not just that the stock is down or the mutual fund is not performing well, but when you really think about like why you got into that investment in the first place, or what are the prospects for that stock in the future, and you've just sort of soured on the whole thing and it's sitting as a loss, like I wouldn't just take a loss just to offset my gains unless I just had a particularly high tax year. But if you really like have an investment that you've kind of soured on and you don't see bright things in the future, it's like you can use that loss to offset however much your gains have piled up. However, the IRS makes a distinction between short-term gains. We talked about this. You own something a year or less and had a gain, or long-term gains. You own something more than a year. So you cannot take short-term gains and apply them, short-term losses and apply them to long-term gains. You cannot mix these. So if you see something that you want to sell because you think you can use that loss, you have to make sure it's apples to apples. You have to make sure that you're using something you've owned for more than a year to offset gains for other things, gains you've realized that you've owned for more than a year. And so you can use your long term for your long term and your short term for your short term, but you can't mix the two. So obviously this is a smart strategy to just, sell something, take the loss, reduce your taxable, your tax liability. However, you have to be really careful, not just about the long-term, short-term thing, but there is something called the wash rule. And it's more complicated than this, but I'm just going to give you a little preview. Like, imagine you sell something and you take the loss, but then, I don't know, you forget that you did that or why you did that. And then, like 3 weeks from now, you repurchase it or you repurchase something very similar. You have just negated what you did. It's called the wash rule. So you can no longer take that loss. So there are a lot of rules around taking a loss, and you just have to be careful. Oddly, supposedly, like with cryptocurrency, the wash rule doesn't apply, but there's a separate rule where the IRS can come sniffing around and be like, wait, you sold that cryptocurrency. It didn't seem like that was, then you like purchased it again 3 days later. That's a little suspicious. So you actually can't trigger a wash rule with cryptocurrency, but you can just do things where you're like, all right, technically you should be allowed to take this loss, but the IRS is going to tell you no anyway, because you sold the cryptocurrency and then purchased it 3 days later. Can't remember the exact terminology, but like just you just use your smarts. Okay. And then hold on. I definitely, before we go, I want to remind everyone of the two upcoming webinars, the Psychology and Investing in November and Alternatives in December. We're right almost at time, but I'm happy to take questions or Q&A. And yeah, let me see. I keep seeing there are two questions in the chat, but I can only see one. What am I doing wrong here? I don't know what I'm doing wrong. All right, I only see one. I see the age limit question for the Roth.
That's
If there
all.
any,
Yeah,
what?
that's
Oh,
all
that's the
I
only one?
see as well. So I'm
Okay. All right. Well,
gonna put in the chat the link for the next session that Kristen just mentioned. So you can click on that link to sign up and receive the Zoom link as well.
oh, perfect. Okay. Any questions before we? Are you still awake? I know taxes are like, if you have insomnia, just grab publication 550 from the IRS. It's all the tax rules around investing. It'll put you right to sleep. Oh wait, I do see one. Let's see. what
Yep,
this
there's a
is. Oh,
question.
that was you. That was you. Okay.
No, there was one. Can you explain qualified donations?
Oh, I'm so glad you said that. I mean, talk about a great way to be tax efficient and charitable. So, I mean, I could talk for 10 minutes about like you can be really tax efficient if you do say you have to do a distribution, like a required minimum distribution from your IRA, or you just feel like taking money from your IRA and giving it to a charity. If you do it the correct way, that is never income to you, right? So um, I think it's QCD, I can't remember the acronym, but it's like there is a way to take money out of your IRA, which should normally, if it's a regular IRA, not a Roth, that should trigger a tax consequence. But if you do it the correct way through your custodian and have the money sent directly to a charity, that is not income to you. The entire amount goes to the charity and it's never considered income to you. And then there's a totally separate thing, a donor advised fund. And that is really interesting if you're going to have like a tax year where you have very high income and you're kind of worried about landing in the 35, 37% bracket. Even if you don't know what charities you want to give money to, you can create through your, again, like a Fidelity or a Vanguard or a Schwab, a typical custodian, they will help you create what's called a donor advised fund. And say you had like this big earning year for whatever reason, say you want to take like $50,000, you just put it in that fund. And then for years afterward, you can slowly disperse it to charities that interest you, but you get the tax deduction in the year you create it. So I love donor advised funds. That's a super way to be tax smart. Okay, now are we getting more questions? I
So there
feel like,
are a couple more questions that just came in, and I also posted a link because actually next Wednesday, Julie Jason is going to be doing a in-person workshop on qualified charitable distributions on exactly that topic. So that's next Wednesday evening at Greenwich Library. So I figured I would mention that as well.
yeah. There's another great question here. Can you open a Roth if you are already taking required minimum distributions? Again, I don't know. Like that's a great question. I mean, I would think you can. If your required minimum distributions are really high, then you're already in a pretty high tax bracket. So you've missed your opportunity to be like in between taking a salary and you haven't started your required minimums distribution. So that's like kind of those the years that they wanted you to like, grab those years where all of a sudden you artificially have low income. Like it's a joke to me when I hear some very high paid executive is taking a sabbatical for his family or her family. I never think that's true. I always think like they're just trying to create this one year where they don't have a lot of income so they can do Roth conversions. But if you're already taking required minimum distributions, but they're relatively low, like say they're only like 30 or 40,000, like the tax reason might still make a lot of sense to do the Roth. But are you allowed to do it? Like, that's really interesting. I've never heard that you're not allowed. I've never heard of an age limit. But I'm going to write both of these down and I'll get back to you. Uh, okay. I think that's it. I think that's it.
All right, I'm glad we had some questions come in there at the end. Those were good questions.
Very
Um,
good questions.
all right, well, thank you, Kristen, and thank you everyone for joining us this evening. And once that link goes on our YouTube page, I will share that again, and I'll also send the link for November. So
All right.
look
And
out for
if you
that.
want me to follow up on these questions, like Siobhan, can they email you and then like I'll make sure that I get back to them or
Yeah, that works. Or if you have those specific questions, I can share that in an email, the answer to them in an email that I send to everyone. If
Oh, okay.
you,
That's a good idea. So we'll
yeah.
work on that because I'll chase down these answers.
Okay, perfect.
Okay. All right.
All right,
All
great.
right. Thanks, everybody. Good
Thank
night.
you. Have a great night.